It is a great pleasure to welcome to this conversation on Irish banks and also UK and European banks, John Cronin, financials industry analyst. He is founder of Seapoint Insights and also has a Substack, Financials Unshackled, which I would highly recommend to all of our listeners. John, welcome.
Thanks, John. Great to be on the program.
So I'd love to hear a little bit more about you and your path and background in financials, the area you focus on.
Sure. Look, I had been working as an equity analyst and doing some fixed income credit analysis as well on the UK and Irish banking space for the best part of 10 years until I left the industry in the spring of this year to go out on my own. I had worked with Goodbody in Dublin and with Investec as well prior to that. So that was predominantly covering UK and Irish banks and some real estate stocks too. Prior to that, I had been at the Department of Finance in Dublin on an elongated secondment to work on restructuring the banking system. So that was within their shareholding and financial advisory division, which is the unit that manages the state's shareholdings and investments in the banking sector. And prior to that, I had a long career at AIB, working for the head of a newly post-crisis formed group strategy and corporate development team for a period, and prior to that in corporate finance, where I was quite actively involved in advising the board on the divestment of certain businesses following the fallout from the financial crisis. So I launched in the spring of this year. I went out on my own earlier this year and founded Seapoint Insights over the summer months and launched my newsletter, Financials Unshackled, which is freely available on Substack, and it discusses key banking developments in the UK, Irish, and global banking context on a regular basis. And also, I'm just doing some other work with various parties outside of just doing the newsletter.
And you do such wonderful in-depth work on banks on your Substack. That's why it is such a great read and well worth following. John, today we will focus primarily on Irish banks, an area of expertise and where you believe there are opportunities for investors as well. So why don't we delve into Irish banks? Perhaps you can set the stage for us.
Thanks, John. Absolutely. Look, I think a lot of your listeners will be familiar with the intense boom and bust that Ireland experienced. But I think it is worth casting our minds back through history very briefly to set the scene, as you say, and to get a good picture of how the Irish banking landscape looks today and why that is. So, we had a very competitive sector back, if we think about what things looked like back in 2008, where you had a large number of competitors in the Irish market, some of whom are still here, like AIB and Bank of Ireland, and Permanent TSB, which was part of a wider group at that point, including an insurance business. Anglo-Irish Bank, which has been effectively liquidated, and Ulster Bank, Bank of Scotland, and KBC, all active in the market to varying extents. That competitive backdrop, saw ill-disciplined pricing behaviour at a time when capital requirements were considerably lighter than where they reside today. And, look, it's quite well known that the Irish banks ran into severe credit and liquidity issues and required a state bailout, which saw the Irish state come in and take a majority shareholding in AIB and PTSB and a 35% shareholding in Bank of Ireland, which fared slightly better through the crisis period. So in the aftermath of the global financial crisis and through the course of these bailouts, we saw, as I mentioned earlier, Anglo-Irish Bank was liquidated, Bank of Scotland exited the market, And there was a reduced scale of ambition as well on the part of Ulster Bank. That led to a less, albeit still a quite strongly competitive space. Um, so when I say Ulster had a reduced scale of ambition, they did set out very lofty loan growth targets prior to the crash, and they reined those in, but they were still a very active player in the market until their recent decision to exit. Now, much of the last decade did focus on cleaning up bank balance sheets. It was elusive in terms of, even though the macro was performing quite strongly, loan growth was seemingly elusive for the most part of the last decade. And NPL reduction efforts were the focus, as well as, the and through that period, really, the Irish banks weren't printing anything greater than high single digit returns. That was a function of a number of things, not necessarily the fact that it was a very competitive space with Ulster Bank quite active and KBC quite active, but actually the Irish banks had their risk weights rewritten in response to the financial crisis, and actually they stand out like a sore thumb in a European context, and still do, in fact, where that was a massive returns that was massively drove substantive returns erosion. And in the negative rate backdrop, we really just saw pretty lackluster returns. But a few things have happened in recent years to really change the landscape. First of all, in 2021, Ulster Bank announced that it was exiting the market. This was a bit of a no-brainer from NatWest Group's perspective. The regulatory backdrop, and I'll come to it in more detail momentarily, but the regulatory backdrop in Ireland is quite severe, and Ulster Bank suffered enormously high risk weights on its lending, as well as having a lot of capital trapped in the Irish market. So given the commitment that NatWest Group's board had made to its shareholders in terms of getting down to its CET1 capital ratio target and distributing excess capital effectively to get there, given that it had about 2 percentage points of CET1 capital, which is enormous in the context of shareholder distribution capability, 2 percentage points tied up in the Irish market, it made sense for them to look to crystallise that. And in 2021, they started the process of selling loan portfolios to AIB and PTSB in the main. KBC also announced in 2021 that they would depart. There was always a kind of question mark, I guess, hanging over KBC. They didn't commit for some time that Ireland was a core market, and then they did, but they didn't really ramp up lending significantly when they made that commitment. And then in 2021, it was announced in the spring of that year that Bank of Ireland has agreed to acquire the vast bulk of KBC's portfolio, including a £4.5 billion deposit book. So you've essentially, stepping back, had two waves of exits here, where the Anglo-Irish Bank and Bank of Scotland and a few other foreign players who wouldn't have been as significant, leaving the market in the aftermath of the global financial crisis, and then in 2021, Ulster Bank and KBC jumping ship. So, and concurrently, or shortly after Ulster Bank and KBC's announcements, we've had official rates move up quite significantly. So those twin factors have been instrumental in terms of returns build at a domestic lender level. So we have three listed Irish banks who command the lion's share of lending in the country in mainstream lending markets. Those are AIB, Bank of Ireland, and PTSB. They're very heavily geared towards retail lending, particularly PTSB, which is largely a mortgage bank, but has been more recently expanding into the SME domain, supported by an acquisition of a few portfolios from Ulster Bank as it exited the market. And AIB and Bank of Ireland, look, they're significant players in the corporate and commercial lending markets as well. But just for context, mortgages are more than 50% of AIB's loan exposures, for example. So quite heavily weighted towards retail lending on balance sheet, which is quite different, I guess, to the US position. And you now have a very concentrated market. What we did see in some recent years were, prior to rates starting to increase, some competition from non-banks. So, for example, Finance Ireland which has been backed by PIMCO, and Dilosk, a more specialist type lender. They did, play around in the mortgage market and, kept the market quite competitive. But as soon as rates started to increase, I mean, it really meant that those players had to opt out because their funding models were punitive in the context of what they could achieve in terms of mortgage pricing. And even this week, we've had news from the agri finance lender and car finance lender, First Citizen, another non-bank in the market, that it's loss making and that it just can't compete, or it can't eke out an adequate return from its lending activities, given the competition, given how cheaply the banks are funded relative to its own funding structure. And so effectively, we do have a very concentrated sector. Mortgage drawdowns would be a case in point. So if I look at the year to date, or the data at least up to the half year, the three listed banks commanded 90% or represented 90% of mortgage drawdowns in the first 6 months of this year. So very concentrated. There's a lot of talk about competition in the media. It's on everybody's lips. There are players out in the market making a lot of noise, but we've got to keep it in context. Bank Inter, which owns Avant Money, confirmed in April of this year that it would look to roll out a digital banking proposition in the Irish market. Avant Money has been present in the market for a number of years, and its most recent data show that it commanded an 8% share of mortgage drawdowns, so the vast bulk of the residual outside of the three Irish players, which has been consistent actually over a significant period of time now. So nothing really has changed there yet. 2025 will be interesting to see what they do, but they were very clear on their recent results call, the Q3 call, that it would be a gradual approach to building up in Ireland. And there is a school of thought that they entered the market because of the attractive mortgage pricing before official rates started to climb, a point that I will come to in a bit more detail in a moment as well. So unlikely that their tactic or strategy is to drive the market down in terms of pricing to eke out share. I think it's just a niche market for them to play in. And, the three listed lenders can afford to cede a bit of share and continue to print strong returns. Revolut's making a lot of noise, is talking about rolling out mortgage product in the new year. They've also made a lot of noise in terms of deposit build, and some of your listeners may have seen the headlines around Revolut has 2.7 million accounts in Ireland, which is, I think, the highest in the world in terms of penetration of the population. But the reality is most people don't pay Revolut anything, and we don't have any statistics on the number of people who use it as a primary bank account, but it seems anecdotally very few. And actually that does dovetail with recent noise they made around deposit gathering in the market, where they talked about building to a significant figure very quickly. But in the context of a 245 billion market for Irish deposits, the estimates are that they're nowhere more than 1 billion, despite offering much more attractive rates than the mainstream players. So really, they haven't made inroads yet. Now, look, without going off on a tangent, it would be naive, I think, in the long run to underestimate what players like Revolut or indeed Chase in the UK can do in terms of penetrating a market. But for now, and the medium term, I think it's very difficult to see how they are going to massively disrupt very quickly when there are a lot of question marks around trust and even risk management capability, given they haven't necessarily proven themselves in a maturity transformation context yet. Now, these are issues they can get through for sure in time, but I don't think they're going to transform the market overnight by any stretch. Others who are making a bit of noise are, again, your listeners may have come across the news quite earlier this year that Monzo is effectively using or is applying or in discussions with the Central Bank of Ireland around acquiring a deposit license or a banking license here, and is looking at Ireland as the European hub for its expansion efforts. It's not clear what Monzo's ambition in the domestic market actually is. There is a view that they may be using Ireland as the beachhead for the simple reason that the regulatory regime is quite onerous here. Well, certainly that's the perception internationally. and that if they can meet the bar here where others have, like Revolut was going down the road of applying, Starling Bank was going down the road of applying for a banking license here, and both of those decided against it eventually. So maybe Monzo was thinking that, look, if they can meet the bar here, it's validation of business model effectively. So who knows on that? But they've not started lending in the Irish market or taking deposits anyway yet. And Moco, which is backed by Bavag, which is, look, interesting to see what they'll do, but they've been around for a while now, and we've seen nothing in terms of impact. They write mortgages, but less than 1% of the market. So really, look, a lot of noise in the media and on people's lips around competition, but actually very little change in fact. And the Irish banks continue to, command the lion's share of lending and take and accept the lion's share of deposits. So without being naive to longer term disruption risks, I think, look, in the medium term, it does appear that the domestic players are in a very strong space. One further point I would make on the Irish market as well is, look, you've had a lot of exits. That certainly weighs in boardrooms around Europe and more broadly. The size of the market is very small as well, and to that point around the regulatory backdrop are also seen as off-putting factors. So that hopefully gives one a sense broadly in terms of what the landscape looks like today, John.
Absolutely. That's very helpful. So let's turn maybe to valuations, whether they're still attractive today, and how you think everything will evolve.
Sure. And just before I start into talking on valuations, just want to make it clear that anything that I do convey at this session does not constitute investment research or investment advice or advice of any nature, and I am not an investment advisor. So look, it's for listeners to carry out their own research and due diligence before taking any action. In terms of valuations, I mean, stepping back first, let's have a think about returns. Going back to the start of the decade, so in 2020, before rates started to increase, AIB's target return on tangible equity was for greater than 8%. And Bank of Ireland's target for 2021 return on tangible equity was also in that region. So circa 8% was their language. Now, if you look at the numbers today, you're talking, mid to high teens in terms of returns on tangible equity. But actually, it doesn't tell you the full story. And those return on tangible equity calculations clearly would use an after-tax number. But there's been substantive deferred tax asset utilization at an Irish banking level. And for context there, AIB has still reported at the half year 2.1 billion of deferred tax assets, which it can use to offset against its Irish tax bill. And AIB is mostly now a pure play Irish business. So those returns would actually be late teens if you actually adjust for the tax break. And actually, as well as that, those mid to high teens returns would actually creep up to 20% and slightly above that if you adjust for a normalized capital base. So the Irish banks still carry a lot of excess capital. For context, AIB reported a CET1 capital ratio of 15.8% at the half year, or at the end of the third quarter. Bank of Ireland was at 15.6. Both have targets of greater than 14. But actually, that, without going off on a tangent here, but those targets, which they're working towards, by the way, in terms of distributing, they've started the process of distributing significant excess capital back to their shareholder bases. So they're working their excess capital ratios down. And actually, their target CET1 ratios look a bit rich, actually, in the context of where banks in other jurisdictions perch theirs. So like Barclays and NatWest, these guys are talking 13% territory. The Irish banks are at 14, despite the fact that, for instance, one particular capital buffer, the countercyclical capital buffer, is actually struck at a lower rate in Ireland of 1.5% versus 2% in the UK. So I think, look, those target ratios may come back in time, which will be another leg to the story in due course. But for now, look, you're talking kind of on a more adjusted basis, returns in the circa 20% region. Now, look, those returns are going to fall back a bit, right? Like we've got the the expectation amongst investors is that we will see about 150 basis points of rate reductions. So taking the ECB deposit facility rate down to approximately 1.75% at the end of 2025. But there also are various supportive factors that underpin those very strong returns on tangible equity today. One of which we've spoken about is the lack of competition and the relatively concentrated nature of the landscape rather, and how that has been conducive to what these banks producing very strong returns. And particularly, look, the secret sauce here has been deposits. And I'll come back to that in a moment because I think it is really important to understand the foundations for the returns. But the banks have provided rate sensitivities which show the kind of expectation at a point in time. It's not guidance, they're just disclosures around point in time assessments of what the impact of lower rates would be. But actually they don't capture the full picture because you've got loan growth in the market, you've got nuanced structural hedging strategies that provide some income momentum which wouldn't be captured by just taking a number from the bank's report of the estimate of overlaying a lower rate at a particular point in time. But yet it's hard to, you have to make a lot of assumptions as an analyst, and people do tend to anchor themselves when they do an analytical work on those numbers. So I think that could be, overstating the impacts of what lower rates would do. And actually, if you overlay, even if you take those numbers and you drive down, your expectation for the official rates or the deposit facility rate to 1.75%, you're still talking on an adjusted basis, mid-teens returns here. And actually, where are the banks trading in that context? AIB is trading at 1.04 times tangible book value as of close of today, based on last reported tangible equity. And you're getting a return on an adjusted basis of around 20% for that, which is an implied cost of equity of 20% effectively as things currently stand. So those rates, say that return on tangible equity falls back to 13 to 14%. Well, yeah, then that looks different. But it's not going to fall back to that level mathematically, until 2026. And in the interim, the shareholder distribution story carries on strongly. There's a lot of organic capital generation in the interim before rates find their normalized level. So, when you compare that, this isn't to give a view that AIB is better value than UK banks, but on the face of it, mathematically, those implied cost of equity, the implied cost of equity for investing in the Irish banks is elevated relative to other jurisdictions in Europe. And European implied cost of equities are elevated relative to the US. So I think it's really interesting. And one point I found as an analyst and in my regular engagement with US and European and UK investors was, people were concerned that it was just unsustainable. And I remember AIB had guided that deposit beta, which is the level of pass through of higher deposit or of higher official rates to deposit customers, would be close to 30% back in early 2022. I felt that was very conservative guidance, and I messaged accordingly through my notes and dialogue with investors. But everyone was kind of hinged on the number and worried, what if it does go there? In the end, it didn't. And this year, they're guiding to deposit beta thus far, I suppose, in the year to date, of about 12%. And I think they've had fantastic share price performance over the last couple of years. And the other point is, because they have a significant bias towards interest revenues, investment banks tend to pick them out as, ones not to play as rates come back down. But actually, the returns, what you're getting for paying just over 1 times book, and actually only about 0.84 times book in the case of Bank of Ireland, is an extremely strong returns profile today, and likely into 2025, just extrapolating mathematically, and even beyond then to an extent, because there are some, as I said, nuances around those, around how the banks react to lower rates. One of which is the mortgage pricing. So one of the key factors that has underpinned very strong returns in the context of the higher rate backdrop has been the ability of the Irish banks to maintain extremely low deposit pricing throughout. I will come back to that, but what that has allowed them to do is actually not pass on the full extent of rate increases to mortgage customers, which has kept political heat at bay. It's avoided asset quality problems, all sorts of things. And also, it's arguably and maybe just a byproduct of their strategies. It's made it a less attractive market, really, for an outside competitor to come in to disrupt, because the mortgage spreads have pinned quite a lot. But the extent of the interest revenue boost that the banks have generated by virtue of maintaining very low deposit pricing has facilitated that. So it's only been a partial offset. And actually, as rates come back down, and we've already seen this so far, even though it's early days, the Irish banks are unlikely, in my view, to pass through the full extent of rate reductions to their mortgage customers, and will look to recoup some of the lost benefit, from the low deposit pricing effectively by driving expansion in mortgage spreads. Now, that particular dynamic wouldn't be captured in the rate sensitivity disclosures, for example, and that's just one particular point there. I mean, there are other points where it's you look at interest revenue in isolation, but actually there's the structural hedges that AIB and Bank of Ireland particularly run, are similar to the large UK banks, denote a lot of income resilience. And actually, if you look at particularly in an AIB case where the hedge has been quite actively managed, it should drive actually some decent income momentum near term. So a real tool to protect on the downside. And again, how that evolves and how the maturities evolve and the rates that the swaps come off at, none of that would necessarily be captured in the point in time assessment of rate sensitivities on the downside. So these are other factors that will play to some strong income resilience even as rates come back. And then you've got other factors as well, outside of just interest revenues, where for example, provisioning. The Irish banks took enormous provisions during COVID. The AIB booked 1.46 billion of provisions at the start of COVID, and is now running with I think about 1.57 billion of provisions, 29% of which are represented by post-model adjustments, i.e. they don't relate to any specific lending, and could arguably in some people's eyes be seen as excess provisions. I think, look, some commercial real estate problems aside, there's a substantive shield there at the very least, but there's a scope for some of those provisions to be written back. And indeed, some of them have been already. And even without getting into too much technical detail, stage 2 loans are another case in point where the AIB's coverage on those loans is about 6.5% versus Bank of Ireland's at 3.25%. Now, Bank of Ireland adopts a pretty strict definition. So there's a bit of nuance there, but broadly speaking, most European banks, their coverage on those on stage 2 loans would be about 3%. So that's very high coverage level. So potentially some provision write-backs, certainly a lot of protection on the downside. And then you've got the whole dynamic where Bank of Ireland over the last 8 years or so has built up, on my calculations, more than 200 basis points of CET1 capital by doing synthetic risk transfers on its mortgage portfolio. AIB kicked off its inaugural SRT program actually it was reported in the media at the start of last week that they have completed their first corporate loan transaction in that respect. But certainly one would expect that mortgages, given the very high risk weights on some of AIB's mortgage portfolios, one would expect that those will be in the spotlight too. So there should be some risk density reduction, which is accretive to capital effectively and conducive to return on tangible equity improvement as well. over the coming reporting periods from AIB particularly. I mean, we could see more from Bank of Ireland as well there. So there's a lot of there are a lot of points one needs to think about in terms of how the numbers are going to evolve over the coming years, and just blandly taking a downside risk assessment on a point in time basis and applying that in a model to what interest revenues are going to look like over the course of 25, 26 is going to miss some key ingredients. And not to mention the fact that these other points around provisions and SRTs are all conducive to improve capital accretion and returns improvement.
Well, those are great points on AIB, John. Thank you. Another idea that I believe you view as deserving of special examination is permanent TSB.
It is. It's a less well known. It's a less well known company due to, I suppose, from a stock perspective, size and liquidity considerations. Its market cap, for example, is just over €1 billion, 1.2 billion. Now, I think it's a very interesting one, and I think to understand why we need to just step back again and look at the landscape. In Ireland, we have three banks, listed banks that, as I said, command over 90% of mortgage lending, for example. Now, things might change over time. We have some competition, as I say. Maybe Avant becomes a more significant player. Maybe Revolut gets its act together. But right now, there's a huge dependence, effectively, from the perspective of having a functioning banking system on PTSB continuing to remain active in the market. For example, they are, in the kind of high teens in terms of mortgage drawdown share. So a meaningful player. So the first thing I would say is, look, we need PTSB before we become a market that could closely resemble a duopoly, effectively. If the other outside competitors don't kind of ramp up their presence. Now, PTSB has particular issues. It's not printing returns on tangible equity anywhere close to AIB and Bank of Ireland. Part of that is a function of scale, but also legacy problems. PTSB had an enormous NPLs issue, and 30% of its loan stock is effectively non-performing if you cast your mind back to the later part of the last decade. Management has done an incredible job divesting of NPLs and actually at a capital accretive manner in the context in the case of most of those transactions. But that's where its eye has been, and what they did do was acquire a significant portfolios from Ulster Bank, which has been transformational in terms of growing the scale of the business somewhat. So they're now at kind of total assets in the circa 30 billion region. And but they have a kind of legacy cost problem, so there's work to be done there. But the biggest issue that PTSB faces, in fact, is risk weights again. So I mentioned earlier that in Ireland, risk weights are extremely high relative to other European jurisdictions, and that is true, particularly in a mortgage portfolio context. The local Banking and Payments Federation, which is the trade body for the banks here, has done great work in terms of fleshing out, where some of those assumptions based on history merit re-examination. So on a probability of default and a loss given default particularly perspective, but PTSB suffers more here, and actually PTSB is writing some mortgages at a risk weight of more than 50%. I mean, look, that's unheard of in other markets. Its overall risk density on its mortgage book is in the sort of 40% territory, which is late 30s. It's substantially higher than the case of AIB and Bank of Ireland, which would be low 20s for Bank of Ireland, but mid 20s territory broadly for those two. So they're effectively operating, especially when you think about it from a flow perspective, writing some business at 55% risk weights when their competitors down the road are writing that business at less than half of that. So they basically need to earn twice as much money, to put it simply, to make the same return. that sounds, it's not a sustainable position. I think, look, our understanding, and the company has talked about this in recent results reports. They're working through a project with the regulator, the Irish Central Bank, to split the loan book into pre I think 2015 lending and post 2015 lending. So because you have a dynamic where the lending standards of the past, going back to financial crisis era, are still you know and the risk weights that should have been attached, given how the then bank management teams behaved effectively, are the ones that apply those risk weights. Those risk weights are applied to lending today, which doesn't really make much sense. And actually, PTSB suffers more because, in my understanding, it was one of the first banks that went through the targeted review of internal models process at a European bank level. And look, they seem to have just suffer an adverse outcome effectively, to a greater extent than peer banks. So looking to try and split the book into pre and post 15 lending, with a view to getting some risk-weighted asset relief, could be an enormous point in the context of capital release or capital generation, effectively, and secondly, returns accretion. So with a permanently lower level of capital requirements, that would be naturally returns enhancing. So, I've seen all sorts of estimates around what the numbers could be here. I mean, you could see a 10 percentage point reduction in their risk weights. It's impossible to know. Nobody knows. It's going to come down to the conversations between the regulator and the bank. Of course, these projects can take a long time. One point I would make here, though, is it's not like what we've seen with the UK banks. We're looking for new to IRB models to be approved. This is a pre-existing IRB model that needs just recalibration or reapproval rather than a brand new model. So that's an important distinction here. Not to suggest that it's a slam dunk that they're going to get there in 2025, because it absolutely isn't. But it's certainly, to the extent that they have success in terms of materially driving down their risk weights, that's going to be, very impactful, or potentially very impactful, from a returns perspective, and indeed in terms of facilitating some shareholder distributions. Separately, also, look, management is laser-eye focused on taking out cost, and realizes that, look, it's got a significant cost base of over 500 million per annum that needs to be curtailed. I think, look, that's more of a medium-term project, but some progress there should be constructive as well. And I think, look, you've got the state in there as a 57% shareholder. NatWest still has a double-digit shareholding in the bank. They've stayed on NatWest, have sold some stock last year, and they're effectively in exit mode. So I think that will be an interesting one to watch over the coming year. One other point, John, just to kind of give your listeners a bit more context in terms of the points I made on deposits, is because it's a pretty big point, not only in the context of why the banks have generated very strong returns over recent years, but also and where they're sitting on or generating very strong returns on tangible equity today, but also because of what it means in terms of their funding models going forward. The one overarching point I would make in Ireland is you see a level of depositor inertia that is not reflected in other markets. Just for some numbers on this, so about 245 billion of household and business deposits in the market at the end of October. The Irish macro has been very strong, and savings build has been substantial. But just to put some numbers in that, household and business deposits were 172 billion less than 5 years ago. So a jump of 72 billion in total, with household deposits growing by 50 billion from 110 to 159 at the end of October, and business deposits growing from 62 billion at the start of 2020 to 85 billion. Now, the other story here has been that the lion's share of Irish deposits sit in over current or demand accounts. So, for example, AIB reported at the end of June that 58% of its over 100 billion deposit book sat in current accounts. That's enormous. And 29% sat in demand accounts. So with term or other products constituting the residual 13%. And the numbers are pretty much the exact same in Bank of Ireland, in a Bank of Ireland context. Now, if you look and just shop around for rates in the market, I mean, you don't need me to tell you that current accounts generally are zero interest rated. And then you've got demand accounts where if you look to the UK, you can get quite competitive, easy access rates in that market. Really, the best you're going to do in Ireland in demand is, you get 1% very selectively, but really about 50 basis points. And on term, while you can get up to 3%, that's on 2-year product. It's 1.5% generally on 6-month product. And it's about 2% on 1-year product. So it begs the question as to, given deposits in the market have grown by 72 billion in less than 5 years, so the deposit market has effectively grown by, almost a third in size within a 5-year period. Why are all these monies sitting in current accounts? And it's really hard to explain that. And there have been numerous studies, and there's been a lot of discussion around this. Is it lack of competition? I guess, look, my own thesis is certainly competition, or the relative lack thereof, is a factor, but actually the reality is more nuanced. You've got Raisin and Trade Republic advertising, who've advertised aggressively through the higher rate period. They are platforms that customers can use to allocate their deposits to other banks in Europe that offer higher rates, with the benefit of the government guarantee as well, given the Euro-wide nature of the deposit guarantee scheme. Very few people have used those. You've got local players like Revolut offering premium rates, and yet the flows, as I mentioned earlier, I mean, I think they might have about 1 billion on deposits, but that's just it's not like 0.3% of the market. But even when you look at the banks, as I mentioned, they do offer 3% on term accounts for 2-year product. A lot of that deposit build is surely not money that needs to be accessed overnight. But I wonder, is there just a psychology here where, Ireland's relatively, Ireland's new to wealth. We had a big financial crisis, and historically, very, very Catholic, religious country. And I just wonder, people just think it's too good to be true here, and everyone would just be fear. A lot of people have that fear factor around needing the access to cash just in case everything goes wrong. And I wonder, is that a key point that underpins why so much money is sitting in overnight product? I think there's an element of laziness as well as the fact that deposit interest retention tax is 33%, so it takes a significant chunk out of your returns anyway. A lot of average balances are very low, but not all are. But for people who have 10 or 12 grand on deposit, all the hoops you have to jump through to get that higher price term product, and then you're locking money away. I mean, how much are you really going to save? But look, there are some big chunky deposits that are sitting, at very low rates, and I think, look, that's likely to sustain to a large extent, I would say, given that we didn't see major shift in that as rates went up, and now the rates are coming back again. Look, I would just say, if you haven't moved by now, and actually the banks are confirming as well, most recently, like AIB said on its third quarter call, that flow to term has halved roughly in recent months as rates have come back, which is no great surprise, I guess, but it just shows you, or it cements the, kind of the structural nature of these low interest earning deposits, which really has been the main underpin for the very high returns. So, look, and I think it's going to be very hard for other banks to come into the market and take a big slice of those deposits, because we have had competitors, as I called out, and even within the banks they offer rates, so you could move product within the same institution and people don't bother. So, I think that's a huge protective factor for the Irish.
Well, that's very helpful, John. I'm wondering if we could talk a little bit about consolidation in a European context, and whether you think the Irish banks could become takeover targets over time.
Yeah, good question. And the topic du jour in European banking, given Andrea Orcel, the chief executive of UniCredit's recent move to stake build in Commerzbank. I think, look, first point I would say on that is, you know, we do see, in market consolidation on an ongoing basis in Europe, and we have seen some banks acquire fee income businesses, you know, in recent times, but we've really not seen the advent of significant cross-border consolidation, as it were, in recent times. Since the fallout from the financial crisis, where obviously there were transactions prior to that which didn't end particularly well. Um, and I think, look, the key obstacles are well known. We have a lack of, we don't still have banking union in Europe, and we don't have a unified deposit insurance scheme. Every country has their own. I mean, I mentioned earlier that an Irish person can put money into an Italian bank up to the value of the European deposit guarantee, but we don't have a unified European deposit insurance scheme. And we don't have a common securitization framework. So banking is very much local still in Europe, and policymakers have been consistently calling for capital markets union, banking union, the creation of an EDIS, the securitization framework, but we've seen very little in terms of meaningful progress in that respect. And I suspect that part of the motivation on Andrea Orcell's part is to call policymakers bluff, as it were, and try and force perhaps the completion of the Eurozone banking project. Now, that's easier said than done, and he would, of course, I'm sorry, it's important to mention that, of course, given he has built a stake in Commerce, it seems at least that yeah, UniCredit also sees it as a strategically desirable asset from its own perspective. But look, it seems that some of the problems that have manifested in the wake of his unique stake building effort were probably pretty predictable to him and his team. I the reaction in Germany to the fact that they may be reliant on Italians to bail them out if there was a problem. And that kind of highlights again the local nature of European banking. So I wonder, is it a kind of an attempt for policymakers, or an attempt to kind of see if anything can be done to push policymakers into getting this project done? And the swaps that he entered into in the context of the state build in Commerzbank were, unusually long for such total return swaps. Typically, they would be of 6-month duration, in my understanding, and these ones were 2 years. So it gives some time, I guess, to call the policymakers bluff. Like, the benefits would be well understood in terms of, cross-border consolidation in Europe, particularly the desire for scale, given, the increasing digitization of banking and the investment that will need to continue to be made into future-proofing these organizations. More scale should be desirable in that respect, but we do need to see a breakdown of we need to see more unification in a European context for it to take hold. Now, with that said, then do the Irish come into focus potentially? I mean, there are two ways to look at this. One would be if another player wants to enter into the Irish market for just in terms of opportunistically to eke out attractive returns in the market, given competitive dynamics here. Well, then, is it easier to come in and do it organically, or do you actually go and acquire something? And if you are to go and acquire something, it would seem maybe, and it's a speculative comment, but would PTSB be the vehicle of choice to acquire an instant presence in the market? Indeed, some of those who have committed to the Irish market, some of the foreign players who are already here may indeed have given that some thought. I don't know, but it's certainly a possibility, and it certainly would be a route to developing a presence overnight. And I've spoken already about the challenges in terms of securing deposit customers or getting people to move banks. That's going to be, to the extent you're not funded by a parent in another market, well, then that could be an obstacle in terms of achieving scale ambitions in Ireland for outside players. So maybe then an acquisition comes into focus. I mean, and then the other point is, does another player who is making a real go of a European cross-border consolidation effort. And so for example, if the policymakers did progress all these gaps in terms of what's preventing true cross-border consolidation, which is a bit hopeful because we have been talking about banking union for more than 10 years. Um, does a UniCredit or someone similar come in and look at an AIB and Bank of Ireland and think, wow, these guys are generating, mid-teens returns even in a lower rate backdrop. They're trading at book, not even in the case of Bank of Ireland. This could be massively accretive to my shareholders. Would I take a look? So it's a possibility in the medium term, just like it is for other banks in other markets. No more than that. But I guess it all comes back to the kind of returns you can generate, and back to the arguments. Look, it's not me giving a valuation view. It's mathematics tells you today that the Irish banks, the implied cost of equity or the implied required return on equity for investing in Irish banks is at a premium to other markets in Europe. So if an acquirer takes a different view to what the market is taking in the context of the sustainability or relative sustainability of returns profiles, well then why wouldn't these banks come on the radar? That all said, European cross-border banking consolidation is all talk, no action for the time being.
And John, you clearly have an overwhelmingly positive thesis on Irish banks. I'm wondering if you could also address what you see as the main risks to that thesis.
Absolutely. Look, I think overwhelmingly positive, John. I it certainly, look, I've characterized it as such, and I think, look, I've made some strong arguments as to, that you've got the discrepancy between valuation or required returns in Ireland versus other markets. I think there are lots of reasons that I've been through to show you why the returns, while they will come down from today's levels, there is a degree of sustainability to the strong return profiles. And, you've got a strong macro, which we haven't even really spoken about, and a few of these other things in the background that are all supportive of that. But it's not to say that, because what we haven't spoken about is the risks. So everything has risk. And, the Irish absolutely do as well. I mean, there are a few. One I would say is the macro. So the macro is in an incredibly strong spot. I mean, look, you've got growth rates in terms of modified domestic demand in the 2.5% to 3% territory, which is really a proxy for GDP here. Maybe that could be another conversation at some point. But the low unemployment, benign asset quality, we're running a budget surplus. So conditions very strong in that respect. But look, one headwind potentially here is what happens now as a result of the Trump presidency. So first of all, Trump has said that he wants to cut the US corporation tax rate to 15%. That in and of itself is corrosive in terms of the Irish tax advantage, potentially particularly so from an inward foreign direct investment perspective. And Ireland is very dependent on foreign investment flows for both employment and economic growth, with higher average earners employed by the multinationals. Secondly, look, in terms of tariffs, obviously the broader impact of the mooted tariffs, and clearly Trump's spark has been worse than his bite here historically, but the impact on world trade and protection, that protectionism, is unhelpful in terms of broader economic growth, not just in Ireland, but elsewhere. But then it does raise the kind of question in terms of the Irish multinationals that re-export back to the US, like would those exports be subject to tariffs? And then some of the stuff that doesn't get discussed that widely here, but is really important, is like if you go back to that 2017 US Tax Cuts and Jobs Act, sections of that are subject to a sunset clause that expires at the end of 2025. And there are three key risks, as I see it, in that vein, which would be A, US multinationals that hold intellectual property assets abroad are liable to pay US tax on the resulting profits only up to a threshold level. So that's the global intangible low tax income threshold. And that's already met largely by the tax they pay here in Ireland. But the ability to offset the tax paid in Ireland against the tax payable up to that guilty threshold level is due to reduce, which will erode Ireland's tax advantage. And secondly, US multinationals that have intellectual property in the US but export via Ireland, like Google, benefit from a tax break under that act, where such foreign derived intangible income is taxed at just 13.1%. that's been very helpful for those companies that have used structures that are rooted through Ireland, where the historical 12.5% corporation tax rate, which is going to 15 now, has been closely aligned with that 13.1% rate. But that 13.1% rate is due to increase, which will serve to erode Ireland's tax advantage somewhat as well. And then there's also a base erosion anti-abuse tax provision that is due to change as well in actually January 2026. So look, lots of technical detail here. Stepping back, I would say, look, the risk of like a lot of maybe I don't want to be naive here, but I think the risk of you know the established tech companies and pharma companies and medical device companies, three particular areas where Ireland has been very strong, the risk that those companies will up sticks and leave, I think, is probably quite pessimistic. I think it's a low probability, especially when you look at pharma, where there's well invested active pharmaceutical ingredient manufacturer facilities. Tech, we've got a real hub in Dublin, so I think the network effects alone, and some of these big tech companies have their European headquarters in Dublin. They probably gonna want to have European headquarters somewhere. So like I think it's more impactful from a flow perspective. That's what I would be more worried about. And actually, the NTMA in Ireland has done some interesting work on this. And again, it's just some basic math, but they compute that the kind of school of thought in government circles now in the Department of Finance and the NTMA is that about half of Ireland's corporation tax receipts are excess. So our corporation tax revenues have gone from 11% of the total fiscal take over 10 years ago to about 27, 28% now. They deem half of those to be excess. If you strip those out and the one-off injection from Apple, the court ruling in the Apple case this year, you go from a budget surplus back to a budget deficit of 2.2%. It's not out of kilter with what we see elsewhere in Europe. So I think look, that gives some context to all these issues. It's not like Ireland's going to become a third world country anytime soon, but there are macro risks both from trade and growth perspective as well as from a fiscal tax perspective, tax revenue perspective, and what that could mean for the condition of households and businesses. Look, quite a lot on that, John. I appreciate. I'll just be quicker as I run through some of the others. I think, look, disruption risk and the risk that investment spend needs to go up in banks. It's there. I think, as I said, look, Revolut, they've probably got 1 billion of deposits. We don't have public information on it. That's just kind of that's making an estimate based on various press reports. They want to get into mortgages next year. They don't have great experience in terms of lending, and well, certainly they don't have experience lending in the Irish market. I'm sure there will be hiccups. They have some customer trust issues to work through. Medium term, though, absolutely, and I would say this for other markets as well. And I think what Chase UK is doing in the UK is fascinating. But that disruption risk is a real medium to more longer term point as well. I suppose, but for the nearer term, I just see the Irish banks kind of holding their position, as it were, I guess, in most part. Another risk you've got is official rates go right back down to zero. The Irish banks are very interest revenue biased. That's been constructive on the way up. There's good resilience on the way down through the structural hedging programs, but nobody wants to see negative rates again. That would completely cut through the investment case. And then other factors like the euro could fragment. But I don't think you've got these kind of standard, asset quality risks. There are always risks, but I think the asset quality is in very good shape. It's hard to see a protracted, quick slowdown in loan demand. It's hard to see an enormous flight of deposits. I think there are a lot of good structural support factors there, but there are always risks.
Thank you. That's extremely helpful, John. This has been really a tour de force on bank investing in Ireland. Thank you for that. Maybe we could just do a quick preview of UK banks and how you see them, and we will have another conversation if you're willing to discuss UK banks in depth, but perhaps just give us a very, very quick preview.
Sure, and would be delighted to come back on, John, to discuss the UK. It's a market I've been following extremely closely now for 8 years. So in broad terms, look, I know lately there's been a lot of fallout since the 30th of October budget, but you do have a supportive macro backdrop in most part. And now we at least have a stable political environment as well. So if we think back to the trust debacle of 2 years ago, okay, so gilt yields did blow out a little bit post budget this year, but not enormously. You know, apart from like if you avoid looking at the headlines in some of the pro-Tory newspapers, it does pretty stable environment. And actually, what we're seeing is that is translating into relatively broad-based loan growth. So all the large banks called out at Q3 and in the conferences during September that they are seeing, decent, nothing staggering, but low to mid single digit growth in retail loan books, and then more low single digit growth in commercial books. And importantly as well, because of the rates coming back a little bit, and I know we've got a different dynamic in the UK in terms of rate expectations vis-a-vis Europe, but deposit churn has begun to subside, where that has been a kind of a preeminent point in investors' minds in the UK, where you did see quite a lot of flight to term differentiated to the experience in the Irish market. A lot of flight to even easy access as well for current accounts, with easy access overnight rates quite attractive in the UK market. But that churn is subsiding. And then the large banks, not all of the banks, but the large ones like Barclays, NatWest, HSBCs, Lloyds have, um, they have structural hedging programs where they have locked in a lot of income benefit actually right out through 2026. And those structural hedges, which are really designed to protect against rates falling, official rates falling. So you hedge out the kind of interest rate risk associated with your non-interest earning deposits and equity. And basically those hedges provide a lot of income resilience. So you're actually seeing, despite the fact that rates have been falling, net interest margins expand a little. And also similar to Ireland, benign asset quality. I think that's kind of, really a function of the tightening in regulation post-crisis, where regulators have done an exceptionally good job, including macro-prudential regulations, which really constrain banks' ability to lend at large multiples of income. But also, I think it's a reflection of the changed culture in the industry. You don't have executives now who are chasing runaway growth. You do have compliant, conformist, which is what we want in bank chiefs, and I think that's what we have in the UK and Ireland. And again, look, very strong commitment on the part of all of the large UK banks and the smaller banks indeed, where applicable, to dividends and share buybacks, so shareholder distributions. And you've got a bit of M&A, some opportunistic M&A as well, where even NatWest, Paul Thwaite spoke at the FT Global Banking Summit earlier this week, and he spoke about looking to try and fill in more to the extent that NatWest can secure more attractively priced acquisitions, they'll do it. And when you look at the pricing paid by Barclays and NatWest in terms of the Barclays acquisition of supermarket assets, and the various transactions that have been done in the UK market, they've all been struck at attractive prices, roughly the kind of 0.6 times book space. So look, that's another interesting dynamic in the clever use of capital that I think shareholders have been supportive of for the right deals. In just very brief terms, look, I think I'm not calling out buys, sells, or holds here, but I just think it's worth maybe when we do speak, talking a little bit about a few particular names like Barclays, Metro Bank, and OSB Group. I think they're all at various interesting stages in their evolution, and I think it's important, or I think it would be interesting to flesh out, how things have been developing at those organisations, some of whom have been turning a corner, and how we can expect, or how we should think about how they might evolve in the coming years.
Wonderful. Well, it's going to be a great second conversation as well. This one was terrific, John. Thank you so much. Before I end it, I'll give you the last word. But before I do that, I would just encourage all of our listeners to subscribe and read your wonderful Substack. It is so much in depth on the banking sector in Ireland, the UK, and elsewhere. Once again, the name is Financials Unshackled. John, over to you for the last word.
Well, thanks very much, John, for having me on, and thank you to your listeners for listening to what I have to say on the space. And just to reiterate as well, look, the Financials Unshackled newsletter will evolve in the early new year to include more deep dive content on individual companies and sector developments. So just pop it into Google and subscribe for free. Thank you, John.
Thank you so much. Looking forward to our next conversation already.